Welcome, everyone. It's my great pleasure to invite several of our partners and friends, really, in the capital market space to join me today in sharing some perspectives and observations, perhaps some suggestions with the forum. So my name is Victor Jiang, as Jay mentioned. I'm the chapter president of Keiretsu Australasia. I'm also the founder of Sapient Ventures, a Sydney headquartered venture capital firm. And we've recently branched out into technology focused listed equities. I would like to ask each of our esteemed panelists to introduce themselves, perhaps starting with Anthony.
Hi, Victor. Hello, everyone. Anthony Rumble. I head up the national head of equity capital markets at Baker McKenzie in Sydney. My practice covers the full range of capital markets matters, corporate finance matters, from pre-IPO through IPO and then out the other side to help listed companies raise capital on the ASX.
Great. Gavin.
Thanks, Victor. Yes, I lead Ord Minette's corporate finance tech team, where we focus on private, pre-IPO, IPO, and listed secondary raisings, as well as we also do M&A. We're explicitly focused on emerging companies. So in Australia, that means anything that's basically moving from the private markets to the public markets up to about $2 billion. And recent transactions we've worked on in the tech space include Sezzle, MoneyMe, Cash Rewards, Harmony, and PropTech Group. And Whisper.
Really luminary names on the ASX recently. Tim, love your new moustache, by the way.
Thank you very much. Christmas resolution that kept on going.
Very good.
So my name is Tim Frail. I'm currently the CEO of a business called Fathom AI, which is a Sydney headquartered scale up in the artificial intelligence space. I'm also a non-executive director, and one of our companies is Global Study Partners, which is invested into by Regal in a pre-IPO round. I was Regal's nominated non-exec director as part of that process. In a previous life, I ran a 40 million corporate venture capital arm of an education company with a focus on investing in early stage startups in tech and future workspace.
Great, thanks, team. So I think without further ado, there's a lot of content we could potentially unpack today, so I'll get right into it. I mean, we'll deal with a lot of founders and we heard a couple of great companies present just earlier, and they both have IPO aspirations in the near future. So my question to the panel is, as a CEO embarking on a listing journey, one presumably wants to understand the full cost base associated with a listing, both before, during, and perhaps even after. Could you discuss some of the costs that you're familiar with and also perhaps the compliance requirements in running a listed company?
Why don't I take that one first? Yeah. I mean, the IPO process should not be underestimated from a cost perspective. There are a number of elements in that which go into the IPO and the costs that go into it, from advisory costs as well as the listing costs themselves, of course, and then other just sort of general costs around printing and other sort of what I would describe as ancillary costs. So, in a traditional IPO process, you would have and engage a financial advisor like Ord Minnett, a legal firm to assist you through that process, as well as an accountancy firm, because of the prospectus requirements and the need for a reviewed or an opinion on the financial information that sits in the prospectus. So you've sort of got three major sets of advisory fees right there. And they can, depending on the complication of the business and the sophistication, the complication of the deal, range from a relatively modest amount to a lot. And then clearly one of the major sunk costs that never ceases to surprise my clients is the admission fee that needs to be paid to ASX, and that's general, and that's a function of the expected market capitalization, but can be a number that some people can be surprised by. But I suppose that it's very much a means to an end, and you're looking at the benefit of that listing, and then the nature of an ongoing relationship with ASX, an ongoing relationship with the public markets, and the expectation that comes with that in a number of ways, both from a time cost as well as a pure dollar cost perspective, just a general compliance with the listing rules. And one of the major costs, of course, is the financial disclosure obligations that go with being a listed company: quarterly, half year, and then full year reports. So we sort of think of you're going to have someone, whether that's in your organization or outsourced, who is responsible for obligations of dealing with the ASX and compliance with those listing rule obligations. And then obviously that additional cost, particularly in relation to information management systems and financial reporting systems, which lead into that audit.
Would you say that it's largely a fixed cost base, or is it more proportional to the size of the listing round and the size of the
I think for a listing round, I wouldn't describe it as a fixed cost. I think there can be in my experience at least, be quite a variation in the cost. And that's driven a lot by your choice of advisor. Naturally, there are some advisors who are naturally more expensive than others, and it's also, for at least I can speak from my experience from as a legal advisor in these situations. It can also be very much a function of how complicated the transaction is. And when I talk about that level of complication, one of the major costs that has to be incurred is around due diligence. So in producing a prospectus, you undertake a fairly thorough due diligence process, both from a legal perspective and a financial perspective. And so you can immediately see that the cost that diligence process involves is a function of the business. A fairly simple, straightforward business will naturally incur or require less time and effort, and therefore less cost. A very much multinational, complicated business with different business lines, significant contract base. You can immediately see that requires more time and effort. But it's certainly not a fixed cost per se.
Gavin, in terms of complex transactions, and I think you guys are pretty well qualified to comment on that. Could you speak to some of the cost considerations and things that perhaps folks may need to look out for?
Yeah, I think certainly that the business is at an appropriate scale for listing, and to be aware that there's not a diseconomy in listing relative to a disproportionate amount of revenue, and the scale of the business and the investment that management has to make in running a listed entity with, as you say, the quarterly reporting when they're in a cash flow environment, and then the half yearly and annual reporting, that the diseconomies of that don't outweigh the benefits. And again, a big one that people sometimes underestimate is the commitment around investor education and dealing with the investor requirements once you are in that public domain, which can be another big distraction for management from actually running the company, and then also orders, and then another cost if you were to, say, employ a investor relations firm or the like, which is just another layer of costs on top of those other ones that Anthony outlined.
Is it realistic to give any indication of the sort of range of costs for a given size of raising? For example, a $10 million raise should look like X, a $25 million round should look like Y, or $50 million round should look like Z? Or is that just too hard to generalize?
When you're talking an IPO, it's probably at that smaller end, you don't really get too many economies at that scale. You're going to be well into the sort of north of 10% of your raising fee once you add in all the expenses when you're at a sort of sub 30, sub 40 type listing raise. It's when you get considerably larger, into the near 100 and up north of that you start to really come down in incremental amounts and come into below 10% and into single digits on the overall all-in costs of raising.
Great. Tim, Anthony, did you want to add anything to that on that topic?
I don't think so, Victor, no.
Okay. Next one, that's also very pertinent on many people's minds is what would be an optimal time to list? What sort of state in a company's life cycle, financials or even market conditions would really be most conducive, let's say the sweet spot opportunity for a company to contemplate a listing? And this time we might start with you, Tim.
That's good. I think, unfortunately, the answer is it depends. And the reason why it depends is because any listing decision involves people, and people's situations vary significantly. So, I think the personal aspirations of the current shareholders and management team is important to take into account. Like, some people want to create a world-leading business, in which case you need significant injections of capital at key stages in the company's life. Others want to pursue other motivations. So we shouldn't ignore that. I think as well, in terms of the growth profile of the company, you tend to kind of get through these stages where you do need injections of capital. There are always other sources of capital available, and it's around the pros and cons of going down the VC route, whether the VC market is deep enough in your sector for that level of support, or whether the IPO route is a better way for you to capitalize your business. I would say one other thing as well, which is, especially this is true in the Australian market as it is in Canada and the US, you don't want to list too early for the reasons that we've already discussed in terms of challenges with disclosure and the costs of being a publicly listed company. But also the main reason why you list obviously is to support liquidity, future liquidity. But at the lower end of the market, is the micro cap penny stock space truly liquid? That's something that probably Anthony and other members on the panel can talk to, but you do want to get above the noise and start to actually get coverage on your stock and be able to kind of receive the benefits of an IPO. So I would say not too early, but it does unfortunately depend.
Kevin, we saw recently from the ASX making a bunch of posturings, if I may call it that, in terms of positioning itself as really the preferred choice of capital and liquidity for even for ventures funded companies beyond the, let's say, Series B onwards. Could you comment on that, or what's your perspective on ideal timing, if there could ever be such a thing?
Yeah, and I think the ASX has got to be given full credit here, for, particularly when you look in a US context, that they have been positioning the ASX for potentially Series C and beyond rounds. And the ASX has a strong history of supporting emerging companies, and indeed, it's been even over the shorter term, it's been one of the most active exchanges in the world, and has always had a strong history of supporting those emerging companies. So I think that. And then you saw that conversely in the US, where there was potentially some discussion whether up until about $1 billion in valuation, whether the US market was necessarily as efficient as it could be in terms of the private markets and how they were and how the venture capital space was working. So I think that to Tim's point about listing too early and at the right point, we certainly think that you to institutionalize your register, you do need to be raising sort of 25, 30 million, which is enough to get a solid following of institutions on the register. And remembering that at IPO, it's essentially your formative marketing journey for the company, and it's also your formative register shaping event. So to do it when you've got critical mass and you can get appropriate following and liquidity makes a lot more sense than doing it earlier, when you can't necessarily make the steps and position yourself optimally for the longer journey as a listed entity.
And you touched on something really interesting in the comparative. Sorry, go on, Tim.
No, I was just going to say, I mean, it's probably important that at this stage we just reference the ASX emissions criteria, because I think they're actually surprisingly low. Like, I think when you look at the kind of emissions criteria, then you look at the profit test, the asset test, you know, organizations with 4 million net intangible assets can list. It's just whether it's advisable to at that point. So when we talk about kind of not investing, not raising, not IPOing too early, it's really more of a company judgment decision as to whether you can actually physically access a listing. So I just wanted to point that out because it is actually surprisingly low.
One of the lower ones in the region, right? If not in the world, relative to other major capital markets. In the context, I just want to come back to one point that Gavin mentioned, which is a bit of a comparison between the Australian and US or North American equity markets. You guys have had a lot of experience with Sezzle, which is inherently a US company, but chose to list on the ASX. And by all accounts, it has had a phenomenal run after its listing. I think its share price has multiplied in a very, very short period of time. Could you talk a little bit more to, what drove them to the ASX? What stage of life were they in the lead up to the IPO, and what could be interesting for other companies to know from that particular example?
Yeah, certainly. Sezzle was obviously, it's in the buy now, pay later space, so it's essentially a US pure play equivalent to Afterpay. And they were considering raising capital in the US, and then saw this opportunity to raise in Australia, and were very mindful and very motivated by obviously what Afterpay had done, A, in growing the market here as a consumer product, but B, also familiarizing and educating investors on the space. So as Charlie Youakim, the founder, would say, he was basically having conversations with the potential investors in the US at a certain level. And then he came out to the Australian market, even speaking to generalists, and just the knowledge and awareness of the model was multiples of that. And he was extremely impressed. And that ultimately comes down to the valuation that you get for your company and your cost of capital, and how efficient the market is in identifying that opportunity. And Australian investors and the ASX was essentially able to deliver that for Sezzle, and it's been a fantastic journey for them, and it's also been excellent in terms of positioning the ASX as that potential avenue of capital for comparable companies.
Victor, if I can add to that, sorry. I mean, one of the interesting things about the US when they first started coming to these US companies, when they first started coming, is you've got to remember they are ultimately US companies. So they can't actually list their ordinary shares on the ASX. You list something called a CHESS depository interest, which is the same sort of thing as an ADS or a depository receipt that you get if you listed on NASDAQ, for example. But what's also been interesting, at least in the first sort of wave, was a lot of these companies had to educate investors because, being American companies, they're subject to US laws. They're not subject to the Australian takeovers laws, for example. And what's great now with the likes of Sezzle and others that have gone before them is that education piece has sort of happened, so that we're now in a place where investors are not concerned about the fact that they're investing in a Delaware company. They're not concerned about investing in a CHESS depository interest as opposed to an ordinary share. And that, I think, is to ASX's credit, that because we have this body now, what was perhaps initially an impediment to listing is now no longer such an impediment.
That's a really good segue to the next question I was going to ask, which is around a bit of a comparison, a breakdown of the recent phenomena of SPACs over in the US and how that contrasts to the Australian market. And Anthony, to your point, could you give, for the benefit of the audience, a brief breakdown of what is a SPAC and how that may be of interest or relevance to our Australian context?
Sure. So you're absolutely right. The SPAC is very much flavor of the month in the US, and the numbers of SPACs being listed on the NASDAQ and the numbers that are being spoken about are just quite incredible. at the moment. And we can sort of debate why that's the case. But in essence, a SPAC, or what terms is a special purpose acquisition company, is basically a shell. It's like a cash shell that is listed on the NASDAQ with no historic activities, no revenue, no sort of history, if you will. What you're listing effectively is a shell, or as I said, a shell or a cash box, which is sponsored by a sponsor, and invariably, so what you're investing in is a listed company with a track record, or the sponsor with a track record. So what you're finding is that a lot of these SPACs are being sponsored by people who have had senior management positions with market leading companies. So you're effectively investing into their management expertise and their track record. So the idea being that you list the SPAC, which is pretty cost efficient, pretty effective. It's really a cookie cutter type of process from a documentary perspective. And the company has 18 to 24 months to effectively undertake what's called a de-SPACing transaction, which is the acquisition of the business that will ultimately be the business that will go forward after that process. It won't necessarily have a target in mind when it lists, but equally, you as an investor in a SPAC are investing in a vehicle where the money's put in trust for you for 24 months. If the transaction doesn't happen within the period, in that 24-month period, you get your money back with interest. But ultimately, the idea being that it'll undertake a transaction, and interestingly, you get an opportunity to redeem your money at that time if you don't like the transaction. So it's something that is very much flavour of the month. Now, the debate that a lot of people have been having is that something that we'll see in Australia? Australia has not had a good history with cash boxes or these sort of structures, and as recently as last week, ASX have given a fairly strong indication to the market that they don't see that situation changing. As currently sits, a SPAC or a cash box would not be eligible to list on the ASX because of the requirements in the admission criteria that Tim spoke to around having effectively an operating business or more than 50% of your cash committed. And so it's not something that can currently work. And the indications from ASX are that that position's unfortunately not likely to change anytime soon. But the debate is, well, do we act? And ASX's position quite rightly is, well, we don't feel we need that sort of structure in the Australian market.
Gavin, anything to add to that?
Yeah, I think that the Australian market operates pretty efficiently in allowing companies of that scale to access capital. We were talking to a company just this morning that had talked about the SPAC route, and really it came down to, well, is it worth the loss of autonomy? Is there an efficient path to market for them here? And then also they operated in a relatively narrow vertical, and we would back them to be the strongest in domain expertise of anyone in the space, and really sort of wonder, well, what benefit would the SPAC add in that instance when they're as knowledgeable in their particular vertical as anyone. But there are obviously other cases where they can be quite advantageous, but probably not coming to the ASX or needed necessarily in the ASX environment as much as they may be overseas.
Tim, last word on SPACs versus typical front door IPOs. What would you do with your companies?
I first became exposed to SPACs back in 2018 when I was doing a fair bit of work with Ibis Capital, and they launched EdTechX Holdings on NASDAQ, which was a vehicle for investing in EdTech, education technology companies. And the interesting thing about it is in education as a sector, it's very underrepresented on public markets. So from a diversity play, there was a thematic around investors will seek diversity, invest in our business, but also it was actually a very viable path to market. Some quite large companies or spin-outs from privately owned companies. And they eventually ended up taking a Chinese English language company onto the NASDAQ, and that's now the ongoing company that the shareholders have an interest in. I think in Australia, like I'll just talk in terms of Regal, I can't talk in terms of Regal strategy or anything like that, but the vehicles by which they invest emerging companies funds, which is closed-end fund, or emerging companies opportunities funds, which is open-ended. But the point is that's a vehicle that's established to invest in early-stage private businesses, pre-IPO rounds, and then also hold microcap stocks. So the point is that is a specific part of the market that Regal wants to invest in. They feel it's underrepresented in terms of investor interest, and they think that there's good returns. And, historic fund performance would indicate that they're onto something. I'd say in Australia, the one thing we haven't talked about is the RTOs as well. Like, I mean, with the Perth market, out of mining shells, I'm sure Anthony and Gavin could talk way more about that, but the principle is there is a third path, which is around RTOs, and they probably will always have a place in the Australian market. I would always bow to Anthony and Gavin's experience in terms of whether the SPACs will come onto the Australian market. I think there's quite a lot of interest from principals looking at Australian businesses and then looking to take those onto the NASDAQ. I think there's a fair bit of interest about that at the moment because of the potential multiple arbitrage that you can get by putting it onto the NASDAQ. But as they say, I don't think it's going to become common in Australia anytime soon.
I'm just seeing Jay coming back, so it probably means that it's wrap time. I would just say it's certainly been a very interesting ride on the ASX the last 12 months or so. Some really interesting moves in the buy now, pay later and tech sector in general. So one last word from each of you. Is it going to be a bull run this year, do you think? If you had to make a prediction.
Well, we're still seeing pretty strong activity, Victor. Our sense is that the IPOs are strong. There's still heavy and healthy interest in IPOs, and still healthy interest in good growth stories. You just have to look at Afterpay today announcing a convertible zero coupon convertible note for over $1 billion. There's still a very healthy level of cash out there looking for a home. So all things being equal, never say never type of cliches, but at the moment we're look, last year was an incredible year, of course, in terms of the capital markets and just the sheer volume. So particularly in relation to listed company raisings, I don't think we'll have that repeat, but at the moment we'll see a pretty solid year, I think.
Gavin and Tim, very briefly.
Yes, certainly. I think investor appetite remains pretty strong. Yes, valuations are reasonably full, but macro backdrop remains supportive, and low rates are part of the economic backdrop at this point. So there will be sell-offs, but more broadly, I think that appetite remains pretty good for quality companies to come to the market.
Speaking of which, there's a coming.
Something that Anthony mentioned is that there's a lot of cash out there looking for a home and looking for yield. Like, the interesting thing about the SPAC structure in the US is that a lot of hedge funds are using them as a place to park cash, always having the option not to invest at the point where they've identified a company. I would say I would guess it's going to be a K-shaped recovery. There's going to be sectors which get decimated, and there's going to be sectors that do incredibly well. So I think the point is being able to understand the big macro thematics play out, and being able to bet on a sector, and then also to be able to invest in great companies in that sector. And I think you should do pretty well.
Fantastic. Thank you very much once again to my very esteemed fellow panelists, and for sharing your awesome insights. Anthony from Baker McKenzie, Gavin from Ord Minnett, and Tim from, as a Regal representative on Global Study Partners. Thank you very much.
Thank you, our pleasure.
Thanks, Victor. Thanks, everyone.